Bitcoins, maybe I should get some. Do you have any?
Have you ever heard of Bitcoin? It's a digital currency.
To me, it smells like Ponzi scheme and the greater fool theory, right?
Brother, can you spare a Bitcoin?
Bitcoins. You never heard of them a few weeks ago? Now everybody's talking about them, but is it a currency?
I don't know.
In 2008, the financial system as we know it was in crisis. Major Wall Street institutions were collapsing while stock markets around the world were in freefall. Governments were desperately trying to control the damage while the taxpayer footed the bill. And it's out of this chaos that Bitcoin was born. But to understand why Bitcoin emerged when it did, we first need to understand how the crisis itself came about. Because it didn't happen overnight. The wheels had been turning for years as we inched ever closer to the precipice. You see, after the dot-com bubble burst in 2000, the US economy slowed dramatically and the Federal Reserve needed to find a way to prevent a recession. So, in an act of desperation, they cut interest rates. Not once, not twice, but 13 times. The benchmark rate fell from 6.5% in late 2000 to just 1% by June 2003, its lowest level since the 1950s. At the same time, the US government was actively trying to expand home ownership, introducing policies designed to lower some of the barriers to buying a home. Mortgage credit became easier to obtain, demand for housing surged, and by 2004, almost 70% of Americans owned their home. Sounds good, right? Well, not so fast. You see, lenders were increasingly offering mortgages to people with poor credit histories who would otherwise have struggled to borrow at all. These loans became known as subprime mortgages, and at one point, roughly 20% of new mortgages were subprime. Lending standards became so relaxed that some lenders even offered so-called ninja loans, where the borrower had no income, no job, and no assets. What could possibly go wrong? But how did subprime mortgages become so common? Well, a big reason was the rise of the shadow banking system. Mortgage companies, investment banks, and other financial institutions increasingly took on bank-like roles. Whenever a normal bank offered out a mortgage, they basically sold that debt to an investment bank who would bundle that debt and repackage it as a mortgage-backed security, or MBS. And when parts of those bundles became harder to sell, they were repackaged again as collateralized debt obligations, or CDOs. Both products were sold to investors who were seeking a yield. Anyway, this created a dangerous incentive. Because lenders could sell mortgages further up the chain, they had no reason to care anymore if a borrower defaulted. They only cared about selling mortgages in the first place. And to sell more mortgages, lending standards were pushed lower and lower. In any case, this system became incredibly complex, and that complexity gave a false impression that everything was being handled correctly. To make things worse, credit rating agencies were assessing MBS and CDO products using limited historical data. As such, lots of this debt was given a AAA rating, leading investors to believe it was safe. In reality, though, it wasn't. On the surface, it seemed like nothing could possibly go wrong. People were getting mortgages, lenders could generate fees before passing on the liabilities, and Wall Street could sell the securities to investors. Everyone, it seemed, was a winner. And with so much money being thrown into the housing market, house prices went up and up. Lenders believed that even if a borrower defaulted, they could just sell the house and still make a profit. Pretty quickly, though, things began to fall apart. Many subprime borrowers had adjustable rate mortgages with low introductory payments. Once those introductory periods ended, however, monthly payments jumped sharply. At the same time, house prices stopped rising and refinancing became much harder. And after years of increasingly loose lending standards, defaults started to skyrocket. As house prices fell and defaults climbed, the MBS and CDO products built on those mortgages lost value. Investors backed away, prices collapsed further, and banks, insurers, pension funds, and other institutions holding billions of dollars of mortgage-related securities suffered enormous losses. And what's more, Wall Street had another problem: leverage. Institutions had borrowed heavily to make larger bets in the housing market. Now, much of this leverage depended on short-term borrowing. Once confidence faded, though, and other institutions stopped lending, firms were suddenly bleeding cash. And that's when the collapse really began. New Century, one of America's biggest subprime lenders, filed for bankruptcy in April 2007. And two Bear Stearns hedge funds collapsed that summer. In fact, Bear Stearns itself came close to failure in March 2008. And by September, the panic had become systemic. Lehman Brothers filed for bankruptcy, AIG was pushed to the brink, Washington Mutual became the largest bank failure in US history, and financial institutions became too afraid to lend to each other. The fallout was enormous. More than $19 trillion in household wealth disappeared. Unemployment reached 10%, and the S&P 500 fell 37% in 2008 alone. But the effects were felt for years after. Between 2000 and 2007, just 25 US banks failed. Between 2008 and 2015, though, a massive 515 went bust. Now, once the financial system started collapsing, governments and central banks found themselves faced with an ugly choice. They could stand back and let major institutions fail, risking an even deeper economic collapse, or they could step in and rescue a system that had helped create the crisis in the first place. And so, step in they did. When AIG was pushed to the brink in September 2008, the Federal Reserve authorized an emergency loan of up to $85 billion to keep the company alive. The following month, Congress approved the Troubled Asset Relief Program, or TARP. Essentially, TARP allowed the US government to commit up to $700 billion, which was earmarked to stabilize the financial system. Within weeks, billions of dollars were being injected directly into major American banks. The Federal Reserve, though, went even further. By December 2008, it had effectively cut interest rates to zero. It then began purchasing financial assets by the bucket load. The program that became known as quantitative easing eventually included purchases of up to $1.25 trillion of agency mortgage-backed securities, alongside up to $200 billion of agency debt and $300 billion of longer-term Treasury securities. Across TARP-funded programs, the government disbursed more than $443 billion. After repayments, asset sales, dividends, interest, and other income, the program's estimated lifetime cost was around $31 billion. From the government's perspective, these measures were designed to stop a financial panic from turning into something even worse. But that didn't make the public any less furious. While the institutions responsible for the worst financial crisis since the Great Depression were being saved, millions of ordinary Americans were losing their jobs. They could do nothing but watch their savings collapse, while many struggled to keep their homes. And that disparity between how the public was treated compared to how institutions were treated left a powerful impression. When ordinary people made bad financial decisions, however minor they may have been, they suffered the consequences. But when institutions considered too big to fail made catastrophic mistakes, the entire system mobilized to save them. For many people, this crisis proved that the financial system is fundamentally rigged. Profits had stayed with private companies during the boom, while the risk of total collapse became a problem for the public. But the crisis also exposed something deeper about the financial system. It was essentially a house of cards built on trust. Trust that regulators had set the right guardrails. trust that credit agencies could assess risk properly, trust that the Fed would manage monetary policy correctly, and of course, trust that banks would act responsibly. And yet, the very institutions people relied on had either helped fuel the disaster or failed to stop it. So, 2008 showed what can happen when those institutions get things badly wrong. Banks had misjudged risk, regulators had failed to contain it, and when the damage became severe enough, central banks and governments had to intervene on a scale that almost nobody had imagined. The problem is, though, the stability of the financial system ultimately depends on governments, central banks, and financial institutions acting responsibly. 2008, though, showed just how flawed this system really is. To many, it became crystal clear that for a monetary system to truly work, that trust had to be removed entirely. And this is where Bitcoin enters the picture. But before we get into that, I need to tell you about the Coin Bureau's Telegram channel. That's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. So, sign up today using the link in the description or the QR code on screen. And now, back to the video. So, by this point, you know how the 2008 financial crisis proved that the system isn't fit for purpose. In this sense, Bitcoin was created at the perfect moment. It was launched in January 2009, although its white paper was released in October 2008, just weeks after the crash was at its worst point. That white paper offered the first working solution that allowed people to send money to one another digitally without ever relying on the same intermediaries that had just failed them. But that white paper didn't come from nowhere. In fact, cypherpunks had tried to create a digital cash system for decades. Now, for context, cypherpunks are people who advocate for the right to preserve privacy, freedom of speech, and censorship resistance. The cypherpunk movement emerged in the 1990s, built around a group of cryptographers and privacy activists, including Eric Hughes, Timothy May, and John Gilmore. In 1992, they established the famous cypherpunks mailing list, while hacker Jude Milhon coined the name cypherpunk. And that mailing list soon had 2,000 members, consisting of some of the sharpest minds on the planet, including cryptographers, hackers, computer scientists, and mathematicians. And this is where Bitcoin's story really begins, because within that community were some of the most important names who helped pioneer the foundations that Bitcoin was built on. One of the first pioneers was David Chaum, who invented blind signatures in 1982. Now, these allowed digital payments to be verified while protecting the identity of the person making them. Chaum later created a company called DigiCash and developed a working electronic payment system called eCash. But although eCash provided impressive privacy features, it still depended on banks and a central company to operate. DigiCash eventually filed for bankruptcy in 1998, and the currency died along with it. In 1997, Adam Back introduced a system called Hashcash, which required computers to perform small amounts of computational work before sending an email. It was originally designed to fight spam, but the underlying proof-of-work concept would later become the mechanism that underpins the entire Bitcoin network. In fact, Adam Back's Hashcash is directly referenced in the Bitcoin white paper. Then, in 1998, Wei Dai proposed something called B-Money, a system where people could use computational work to create digital cash and collectively keep track of balances. Notably, B-Money is also cited in the Bitcoin white paper, as the very first reference, in fact. Nick Szabo later described BitGold, which proposed using computational work and cryptography to create scarce digital assets without relying on a central issuer. Now, even though neither B-Money nor BitGold became a functioning currency, both contained ideas that came remarkably close to the ideas behind Bitcoin. Another major step came from Hal Finney in 2004. His system, called Reusable Proofs of Work, or RPOW, took a similar approach to Hashcash, using proof of work to create tokens that could be transferred from person to person. In other words, computational work could now create something scarce that could actually change hands. But there was a catch. RPOW depended on a trusted central server to keep track of those tokens and make sure nobody spent the same one twice. Now, this is the infamous double spend problem, and it's the same problem that everyone kept running into. You see, it's easy to copy digital information. For instance, if you send someone a photo, you still have your own copy. But digital money can't work that way. If somebody could simply duplicate a digital coin and send that same coin again somewhere else, or duplicate it as many times as they want, then that money becomes worthless. Of course, banks already solve this issue by maintaining a central ledger. They keep track of who owns what, and if somebody tries to spend money they've already spent, the bank rejects the transaction. But if your goal is digital money without a bank in control, you've just removed the institution responsible for preventing that double spend. So, while several smart cypherpunks had created a form of digital currency, nobody had managed to build a digital currency that could agree on who owned what, or prevent double spending without putting a trusted company, bank, or other authority in charge. That is, until 2008, when someone calling themselves Satoshi Nakamoto claimed to have found a way. So then, who is Satoshi Nakamoto? Well, back then, nobody knew who Satoshi was, and to this day, their identity remains unknown. But on the 31st of October 2008, while the financial crisis was still tearing through the global economy, Satoshi posted a 9-page white paper to a cryptography mailing list titled Bitcoin, a peer-to-peer electronic cash system. In that white paper, Satoshi described Bitcoin as, quote, a purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. Instead of relying on a bank or intermediary to approve transactions, Bitcoin uses a network of computers that collectively maintain a shared record of every transaction. Now, those transactions are grouped into blocks, and every new block is linked to the ones that came before, creating a public history that becomes increasingly difficult to alter. That record became what we now call the blockchain. But that still left the double spending problem. If there was no bank keeping the official ledger, how could thousands of independent computers agree on which transactions were legitimate? Well, Satoshi's answer was a proof-of-work system that built on the idea Adam Back had introduced with Hashcash. Computers on the network compete to solve a computational problem, and the winner earns the right to process the next block of transactions. The network follows the valid chain containing the greatest accumulated proof of work, giving everyone a way to agree on a single transaction history without appointing an institution to oversee it. Now, this process also created new bitcoins, now largely known as BTC, the native currency of the Bitcoin network. The computers performing this work became known as miners and were rewarded with newly issued BTC, giving people an incentive to spend computing power securing the network. And unlike a traditional currency, Bitcoin's issuance wasn't left to the discretion of a central bank. Its supply was hard-capped at 21 million, meaning there will only ever be a maximum of 21 million BTC in existence. And what's more, the rate of issuance wasn't determined by a person or central entity either. The rules governing the creation of new BTC were written into the software itself. New coins would be released according to a predetermined schedule, with the mining reward cut in half roughly every 4 years. This event became known as the halving, and the process will continue until Bitcoin approaches its maximum supply of 21 million BTC. Now, this was the breakthrough the cypherpunks had been pushing towards. Satoshi took ideas that cryptographers had been developing for decades and combined them into a single working system. Peer-to-peer payments, a shared transaction history, proof of work, and a monetary supply governed by predetermined rules rather than the decisions of a central authority. For the first time, there was a blueprint for digital money that didn't require a bank in the middle. Now, just over 2 months after publishing the Bitcoin white paper, Satoshi Nakamoto put the system into motion. On the 3rd of January 2009, the first ever Bitcoin block was created. This became known as the Genesis block and served as the starting point from which the rest of the Bitcoin blockchain would grow. But hidden inside that Genesis block is something unusual. Satoshi had embedded a short piece of text into its data, and it had nothing to do with Bitcoin's code. It read, quote, "The Times, 3rd of January 2009, Chancellor on brink of second bailout for banks." That was the headline on the front page of the British newspaper The Times that very same day. The article reported that UK Chancellor Alistair Darling was considering another rescue package for Britain's banks as the financial crisis continued and lending remained severely restricted. And the timing is hard to ignore. Only a few months earlier, the British government had announced a major rescue of its banking system, including at least £50 billion to recapitalise banks, alongside additional liquidity support and government guarantees. Yet by January 2009, the possibility of further intervention was already being discussed. Clearly, the first intervention wasn't enough. The system was still failing. Now, we can't know for sure why Satoshi chose that particular headline. However, the fact that it was a British headline, along with the British spelling in Satoshi's writing, has sparked plenty of speculation over the years. We won't speculate here on Satoshi's identity, though, but you're more than welcome to look into that in your own time. Whatever the reason, though, this headline served as a timestamp of sorts, proving that the Genesis block couldn't have possibly existed before the 3rd of January 2009. But placing a headline about a repeat bank bailout inside the first block of a currency designed to operate without banks was very likely a deliberate comment on the very financial system Bitcoin was challenging. And this makes sense. The cypherpunk movement had a strong anti-establishment streak. In any case, that headline perfectly captured the world that Bitcoin was born into. Governments were rescuing banks, central banks were intervening on an extraordinary scale, and confidence in the existing financial system had been badly damaged. And inside Bitcoin's first ever block is a permanent reminder of that moment. Bitcoin's technology may have been built from decades of work by cryptographers and cypherpunks, but its launch happened against a very specific backdrop. The old financial system was fighting for survival, and a new monetary system had just gone live. Now, if you thought Bitcoin was an instant hit, you'd be wrong. When it first went live in January 2009, almost nobody noticed. There were no exchanges, and the coins themselves had no established market value. In fact, even when Satoshi released the first version of the software as an experiment, he openly warned that the system was still new and could even need to be restarted if something went wrong. And at first, Bitcoin was little more than a strange experiment being run by a handful of programmers and cryptography enthusiasts. As you might recall, one of the earliest of those was Hal Finney, the cypherpunk who had previously created RPOW. Finney downloaded the Bitcoin software almost immediately and became one of the first people besides Satoshi to run it. Satoshi even sent Finney 10 BTC as a test, creating the first known Bitcoin transaction between two people. Those 10 BTC weren't really worth anything at the time, of course. In fact, for much of 2009, Bitcoin had no recognized exchange value at all. People were mining coins on ordinary computers, sending them back and forth, finding bugs, and trying to work out whether this strange new system would even survive. Basically, the only people experimenting with it were nerds and cypherpunks who believed in its potential. But underneath that tiny experiment was a radical proposition. For the first time, there was a working form of digital money with no central issuer and no financial institution required to process payments. Nobody could decide to create millions of extra coins. No central server could simply switch the network off. And not a single person, not even Satoshi, could rewrite Bitcoin's rules whenever they felt like it. The question now, though, was whether anyone would actually want to use it. Sure, it had a handful of early enthusiasts, but what it needed next was people willing to take this internet funny money seriously beyond this unusual bunch. And as we'll see in part 2, those people were not only fascinated by Bitcoin's technology, but also took huge steps towards making Bitcoin what it is today. One of the largest and most important financial assets on Earth. So, stay tuned.